Three, two, one. Welcome to the Default News. My name is Lee Honish. I'm joined, as always, by my partner, Mike Cuevas. How you doing today, Mike?
I am doing good, Lee. How is it in California?
Oh, it's extraordinary, but it is a little cold by my taste. How's it doing out there?
It is snowy and cold, and there's a lot of crazy stuff that seems going on all over the place.
There, we have, as always, some good, some bad, some funny. Mike Cuevas is owner broker of your own exit realty there out in Chicago, and I'm a trainer, and together we've combined to create certified default advocacy training, as many of you may or may not know about. That's out on the road right now, working to better your real estate lives. So we decided to put together the news of the week that we hope is beneficial to you. Is there anything you can think of before we kind of go through some of these stories, Mike?
You know what? Nothing surprises me anymore. So I literally we could just get right to the stories. I mean, we're in a new year, we're in 2012, and I'm telling everybody right now that I truly, truly believe that, we talk about this all the time, Lee, but me and you are both short sale advocates, and we truly believe that short sales are the answer. They're the cure to getting rid of the toxic debt. I mean, it's the last solution I see left.
Absolutely. As always, go visit defaultadvocate.org for more information about getting your certification online. We'll start right now with the Wall Street Journal. I actually saw this story on the newsstand while I was standing at a Starbucks yesterday when it came out. It actually made the front page of the Wall Street Journal. You can certainly go to WSJ.com, look it up in the business section. Bank of America ponders retreat. Bank of America has told U.S. regulators that they are planning on retreating from some points of the country to try to cut down, basically to try to cut down in overhead. The executives in Charlotte of the financial giant and one of the longest-standing banks has basically overextended itself, has about 7,400 U.S. banks. They're a little saturated. The bottom line, they bought a lot of banks, including the now infamous toxic countrywide debt. They're slowly and dangerously hovering around about $5 a share. I suppose I could even look that up while we discuss this, Mike. I mean, what's your take? The word on the street that you and I both know about, the Chase has been circling around Bank of America now for about the last year, trying to work out a buyout. Everybody seems to know about it. Everybody seems to know a lawyer working on it. In response, Bank of America has gone to liquidating a lot of their servicing to try to make
Sure.
themselves cash heavy, right? So
Yep.
that they don't get bought out. What do you
Well,
know?
let's
Uh,
well let's first talk about what they're retreating. So, are you basically saying that they're going to close up some of their branches? Like the branch you may see in the corner of the street here, or and are they trying
yeah,
to
that's
liquidate?
exactly what they're talking about to try to
So
cut down on the general overhead.
yeah, and I mean, my actual servicing rights just got transferred from B of A Loan Servicing to another company, M&T actually. So I have seen it personally myself. Um, I heard the same thing. You know, they are. It's inevitable. I mean, you know, the thing that I hear on the streets is how do they know what they bought when they bought from Countrywide? And if we remember that transaction correctly, the market at that time, if I could recall, was never ever expected to go down as bad as it did. And me being on the front lines, I could even tell you that I never expected that personally either. So, does it surprise me? No. I think that there's a lot more worse things to come out in this year, and I'm just being honest. Is it a good move?
Yeah,
I don't know.
I won't overall, the market in general. I mean, are we back at a too big to fail situation? I put up on the screen, everybody, they're at least at $6.60 as they closed on Friday. But, they've been hovering anywhere between $5 and $6 a share. They've just simply never recovered from basically the countrywide buyout, and now they're debt heavy, and it's obvious that they're not bringing in enough positive cash flow. When you're talking about a company like Bank of America, where the rumors are like one out of every four deals is a Bank of America file, right?
Yep.
They're only closing about 30% of their short sales based on their rumored reports. You're talking about a company, hundreds of thousands of REOs happening per month. I mean, not even yearly, monthly, hundreds of thousands, right?
Yep. Well, let me ask you this though. I mean, B of A, how does this affect them actually on the loans that they service and the loans that they own? I know on the short sale end they're servicing a lot of them, but a lot of times they're servicing them on others' behalfs. And if I don't understand, and I don't think the typical consumer would understand, why would they get rid of the servicing rights if that's something that is actually making them money? I would think.
Well, okay, when you look at any classic buyout format from corporate structure, the one thing that actually keeps you from getting bought out are two things. One is you have a liquid cash position so that, you know, as we've discussed in the seminars and as you can go online to both Default Advocate or my website at honish.com, you can watch the video on how money works. And because they only have to carry a 10% reserve for all the money they carried out, the first thing you really want to do is put a lot of cash, physical cash, right, on file, so that in case you do get a run or you do have an asset pull of any kind from your, basically your depositors, you're strong enough to get billions of dollars in cash the way they have for the servicing rights. They now have the option of buying back their own stock. And just towards the end of the year, as I recall, they were at about $5.30 a share. I would be really interested to see how much stock B of A has actually purchased from themselves over the last month, because they're actually at a little bit of a higher position, as I recall.
What
But in
about
general,
when WAMU went down a couple of years ago? What are we seeing the same thing here? Are we seeing that Bank of America, did WAMU at that time sell out a lot of their servicing rights? And then is this sort of the same trend? I mean, are you saying that there's a good chance that we could see B of A go down?
oh yeah, no, I think that there's a better. My running statement to everybody is, if Bank of America hits $3 or $4 a share, I don't know about Wells Fargo, who's played it a little bit smarter than everybody else. My only question and the biggest the concerns that I'd have on a dramatic default level would be, what does that do when you are literally talking about 25% of the market being dictated by a Bank of America or countrywide file? What does that do for everybody who's in the, how do I politically say it, the not so great equator system once that tie breaks off? Now, everybody should know this, that let's say they do file for protection or whatever they do on a business level. Generally speaking, it doesn't really interfere with the day-to-day business for quite some time.
Sure, it's going to be what, 6 to 12 months before
Right,
that would
before
happen.
regulators or any of that actually goes down. I mean, it wouldn't be like you wake up one day and, equator was off
Sure.
or something.
Well, Lee, let me ask you
Um,
this. I got a quick question because now if we're talking about B of A is a huge bank. I mean, it's the largest. How would this affect, in your opinion, from the banking point of view? And I don't know the answer to this, but how would this affect the market, the real estate market? You know,
I think it would have again, because they've offloaded so much of the servicing with Freddie and Fannie. I'll say this: I think it could have a greater effect with the ultimate question: would more REOs hit the market? Would short sales actually get done? Would deals actually get made? I mean, B of A's stance in general, by only closing, let's say they're only closing 50, the rumor is that they're closing about 30% of their short sales, or the banks in general, based on submission to physical close of short sales. The stories and the reports I hear are anywhere between, let's say it's 50-50, which would be way too astounding for me. I believe it's probably closer to 30. That any of the Alt-A subprime product that's out there that's literally clouding them up has got to be removed and negotiated. And it's obvious they can't sell those notes off to investors the way they did. But the constant push to keep investors out of what I call the upfront real estate market, which is pre-REO, right? That's the upfront market.
Yep.
has been phenomenal to me. In general, it's been, and I think they've done a fantastic job of scaring away investors. But when it affects the ball, when it affects the close, you know this in Chicago, I know this in California. Look, the only people really buying about this time of year are going to be investors looking for sweetheart deals. That's the truth.
Yeah.
What buyer buys your sales, right?
Yep. Well, it's really interesting because I don't know the California stats, Lee, and I don't know how many people actually know this, but
Well, it's nicer here. We have
yeah,
it great year round. It doesn't freeze up like.
right. Here's the stats in Illinois. You know the REOs and here's I don't know what's this is very interesting to me and I have two questions. My first one is that if B of A does, as a matter of fact, absolutely close down. Let's just say that's what this is pointing to. If they actually do close down, um, does that mean that they would be open to liquidating the shadow inventory quicker? Because let's face it, I understand that we all know that there's a lot of houses on the market that have not been released, right? We all know that. Everybody knows
Yes.
that. So the question is that you see so many of these houses not being released, and it's obvious they simply cannot release them all at the same time for two reasons, in my opinion. One is that if they did release it, their stock would go down because the true value of their portfolios would be uncovered and revealed. And two is that it could also hurt the real estate market. I mean, if you put all these foreclosures on the market, and if foreclosure properties are selling for 39% below market value and short sales are selling 20% below market value, I mean, that's going to put more people in negative equity. That's just common sense. So, what do you think on that? Would you think the shadow inventory would come out? Do you think they would just go ahead and liquidate it? Because there's two factors there. There's the whole overall market on how much it could hurt that, and then there's the whole, well, let's just liquidate this thing and get out of it.
My first real attitude is I could see them just liquidating for the sake of liquidation. Again, but with securitized portfolios and the way they're structured, or for the simple terminology, where did the money come from? Okay? If it's Freddie or Fannie money, they're going to do whatever they're going to do, right? They're now a government agency.
Mm-hmm.
So we're going to see homes that are given back to city programs. We're going to see homes that become rentals because that's what the federal government wants to do currently. They have no interest in liquidating and selling off, the money they lend out. That is now your tax dollars at work creating public housing, more or less, and that's a percentage of the properties. Are we talking, if it were like true Bank of America money that they lent out from their personal reserves, not borrowed money, I think it would be prudent for them to liquidate, and it'll be interesting to see what they do in the first quarter to protect themselves for the coming year. I do know this, and tell me if I'm wrong. Right now, though, with Wells, Chase, and B of A, they are trying to make deals aggressively on a short sale level. Yes, there are a few hiccups, but for the most part, right now, short sales are trending up again.
Sure. I mean, well, what else is there to do? We've seen the loan mods that they haven't worked. We have the stats on that. Those could be you could get those at defaultadvocate.org. But I mean, there's no other option. I mean, here's what Lee overall, like, let's just look at the snapshot of the real estate market in general. I mean, we have 4 to 5% interest rates and sales are down. That's like free money. I mean, so to me, there's a much bigger overlying problem than the real estate market. It's the overall economy is going to be what fuels the real estate market back, and they sort of are side by side, and one can't cure the other without the other. It's sort of a
Right.
it's a tough situation. But again, back to short sales. B of A is if we look at their short sale policies, they have definitely gotten better. But yeah, it's odd when Lee. We talked about this the other day. Please go ahead and share your $1 million plan. Your $1 million.
My $1 million plan. Yeah, I'll kind of wrap it up on this on my thought for the $1 million plan. I guess I think that B of A needs to be exceptionally aggressive in their solutions at this point. I had actually sent an email to David Sutherland telling him my ideas, and my idea was really simple. If Bank of America were to do a couple of very simple things. One, before we get to the pragmatic of how to drive more people at it. Number one, they've got, okay, you've seen this, I've seen this, the people I coach have seen this. The banks are holding back the delinquency data intentionally. Okay? There's nothing, no one's ever going to go out of their way. It's literally up to the bank whether or not they want to report it to a credit agency. But what you and I and the people we coach have seen, they're holding back key information about homeowners in early distress so that they have a first shot of being their contact, correct?
Sure. Yep.
And what you and I have both seen and what we've both talked about is real estate professionals, realtors, have a lower credibility factor than bank people, which is phenomenal to me. The number one thing, the first contact a homeowner will make, as much as they despise a corporation, as much as they want to sit in a park and occupy it, the number one thing your clients, when you go and visit a homeowner, the people you coach, the people we coach through CDAT, the number one thing they hear is, well, I'm talking to the bank about a loan modification. It's phenomenal to me. That's phenomenal.
Well, it comes down to the basic fundamental understanding that once the borrower, and this is very, very important to point out, that once the borrower is delinquent and they're 31 days late, their relationship with their servicer and or lender is adversarial. And that very, very basic understanding is what's shocking on it, because they should absolutely, borrowers in that situation should probably not contact the bank first, but they should get some sort of representation, whether that's an attorney, whether that's a good short sale agent or a good default advocate, or if there's somebody that specializes in this line of work for better advice than to sort of listen to and be steered down a road that is going to eventually, bite them in the butt.
Right. Ultimately, that's why I came up with the terminology for real estate agent or realtor was so, on the list, revamp, retool, remove. I'm anti-equator. How many more help desks do you need for equator, Mike? I mean, seriously, it's like every week we got a new help desk. Visit us on Twitter for more help. I mean, I know that you know how to work it. I know the people that we coach know how to work it. But in general, would you think equator is a success?
No, it's stalled the process. I mean, there's been a lot of reasons for the B of A servicing why, the whole you had to start the process over if the offer didn't work out. Like, there's a million and one reasons we could point the finger at. But yeah, for the average realtor who's most likely going to be involved in some sort of type of short sale, it's not an easy task. I mean, it's a big challenge for agents to try to understand equator and get used to it. And then it's impossible to talk to anyone. The easiest way to do business, Lee, is voice to voice, face to face, mano a mano. You can't do business through computers. And that's essentially what equator is. You got to jump through this hoop, jump through that hoop, and the whole personalization touch is gone. And it really could just be a simple process. It could really be streamlined, a simple process. Here's the value. Here's what I'm going to take it or leave it. Tell me when you get an offer. Leave it open. That's it.
Right. And the other idea I've had for Bank of America is, why don't they put up $1 million? Agent who closes the most short sales in one calendar year, they can track it through equator. I mean, at least it'll be good for something. The agent who closes the most short sales in 1 year gets $1 million cash from Bank of America. Now, you and I both know this. A top producing real estate agent would close what, Mike? I mean, your best year was 2010. How many physical files was that?
200 and I think 14.
Okay.
Give or take. I don't know. I don't remember.
Let's say 200 gets you into that sphere as an individual, right? Mm-hmm. And most people would have a team working. I mean, you have great staff. You have great people working with you. Nobody's an island unto themselves, as much as they like to believe it. But let's say 200. It's going to be between 200 and 300 files, even for a team. What would be smart is if an office physically did it behind a broker and they went aggressively after it. To close 200, this is my joke. You close 214 files, you really don't need the $1 million, do you, Mike?
No, you don't necessarily need the $1 million, but
it's nice, but
here's exactly, and here's the thing: like you want to stimulate the short sale market, Lee, Very, very simple. Instead of paying realtors and offering commission of 6%, you offer commission at 7 to 8%, period. Okay, you give realtors the amount of necessary funds, which still mitigates their loss by 17 or 18%. You know, there's no difference here. If you incentivize the private market, being real estate agents, to go out there and tackle the short sale market, give them an extra bonus for doing short sales, they will be happy to tackle on the market. The truth is that the general agent does not want to touch the market. They don't want to touch it. They don't believe it's ever going to close. I mean, only 3 in 10 do. So, of course, they're going to be turned off by it. What happens? Well, the property goes to foreclosure, and the collateral damage goes on and on and on, hurts the neighbor's value, and it's a domino effect. And it's such an easy solution. But you'd think that somebody could come up with this stuff, and it's very, very simple. But I don't know. That's just me, Lee.
No, I completely agree with you, Mike. Let's take a quick time out. We'll reset. We'll have more default news for you right after this.